India's economic outlook for fiscal year 26 presents a mixed bag, with both opportunities and challenges on the horizon. One of the most significant challenges is the trajectory of inflation. While the Reserve Bank of India has projected inflation to moderate, several factors could keep upward pressure on prices. Supply chain disruptions, a lingering effect of the pandemic, and geopolitical tensions continue to impact the availability and cost of essential commodities. Additionally, the monsoon's performance remains a crucial factor for food inflation, as it directly impacts agricultural output. While the monsoon has been relatively normal so far, any significant deviations could lead to price fluctuations in essential food items. Furthermore, the global energy landscape remains volatile, with geopolitical events impacting crude oil prices. India, being a net importer of oil, remains vulnerable to these global price swings. The government's efforts to promote renewable energy and reduce reliance on fossil fuels will be crucial in mitigating the impact of these external shocks. Finally, domestic demand, particularly pent-up demand from the pandemic period, is expected to remain robust. While this is positive for economic growth, it could also contribute to demand-pull inflation, where rising demand outpaces supply, leading to higher prices. The second significant challenge is the potential for rising input costs to fuel a wage price spiral. As businesses grapple with increasing costs for raw materials, energy, and transportation, they may pass these costs onto consumers through higher prices. This, in turn, could lead to demands for higher wages, further fueling inflation. This potential spiral is a significant concern for policymakers, as it can be challenging to control once it takes hold. The Reserve Bank of India will need to carefully balance its mandate of maintaining price stability with supporting economic growth. One of the tools at the RBI's disposal is monetary policy. By adjusting interest rates, the RBI can influence borrowing costs for businesses and consumers, thereby impacting investment and spending decisions. However, raising interest rates too aggressively could stifle economic growth, while keeping them too low could further fuel inflation. Therefore, the RBI faces a delicate balancing act in the coming year. It must closely monitor inflation trends and be prepared to act decisively to keep inflation expectations anchored and ensure sustainable economic growth. Beyond domestic factors, India's economic outlook for fiscal year 26 is intertwined with global developments. The ongoing conflict in Eastern Europe continues to cast a shadow of uncertainty on the global economy. The conflict has already disrupted supply chains, fueled energy price volatility, and dampened global trade, all of which have implications for India. Simultaneously, the US-China trade war, though somewhat subdued recently, remains a simmering tension point in the global economy. Any escalation in trade disputes between these two economic giants could have ripple effects across the globe, impacting trade flows and investment sentiments. Moreover, the trajectory of global interest rates, particularly in developed economies like the United States, will also influence capital flows into emerging markets like India. As interest rates rise in developed economies, investors often shift their funds to seek higher returns, potentially leading to capital outflows from emerging markets. This can impact currency valuations and make it more expensive for countries like India to finance their external debt. The interplay of these global factors creates a complex and uncertain backdrop for India's economic outlook in fiscal year 26. Navigating these choppy waters will require deft policymaking, a focus on strengthening domestic economic fundamentals, and a proactive approach to managing external shocks. The Indian Rupee, like many emerging market currencies, has faced depreciation pressures in recent times. Several factors contribute to this trend. Firstly, the widening current account deficit, driven partly by a surge in imports fueled by pent-up demand and high energy prices, puts downward pressure on the currency. Secondly, the strengthening of the US dollar, fueled by the US Federal Reserve's aggressive interest rate hikes to combat domestic inflation, makes the rupee relatively weaker. This is because a stronger dollar makes imports priced in dollars more expensive, potentially widening the trade deficit and further pressuring the rupee. Thirdly, capital outflows from emerging markets driven by global risk aversion and the search for higher returns in developed economies can also weigh on the rupee. When foreign investors pull out their investments from India, it reduces the demand for rupees, contributing to its depreciation. The Reserve Bank of India has been intervening in the foreign exchange market to curb excessive volatility in the rupee's value. However, managing the rupee's trajectory in the face of these multiple headwinds remains a challenge. A weaker rupee, while making exports more competitive, also makes imports costlier, potentially adding to inflationary pressures.